Imagine two people earning the same salary. One feels behind forever, always stressed about money. The other feels calm, secure, and eventually free. The difference usually isn't luck or secret investments or being good at money. It's something much more ordinary. A simple system, repeated for a long time. In this video, I'll explain what financial freedom actually means, the simplest path to reach it, and realistic examples with real numbers so you can see how it works, even if you're not rich, not perfect, and not obsessed with spreadsheets. Before we start, this video is educational. I'm not financial advisor, and this is not financial advice. I'm not telling you what to do with your money. Everyone's situation is different. Income, family, health, country, taxes, and risk tolerance all matter. What I can do is explain the logic behind financial freedom, share a simple framework, and help you think more clearly about the steps. People hear financial freedom and imagine yacht, luxury, or never working again. But financial freedom can be much simpler. At its core, financial freedom means you can cover your basic living costs without stress. You are not forced into decisions because of money pressure. You have options to rest, to change jobs, to move, to say no. Your money works for you instead of you constantly changing it. It's not about being rich, it's about being untrapped. At the most useful version of financial freedom is this: your investments can support your lifestyle, partially or fully, without you needing to work forever. Some people aim for full retirement, others aim for partial freedom, working less, working differently, or having a safety net so they are not afraid of every unexpected bill. If I had to reduce the path to financial freedom in one sentence, it would be: live below your means, invest the difference consistently, and give it time. This sounds too simple, and that's why people don't believe it. But most complicated financial systems are just distractions from the same basic engine. Savings rate, consistency, time, low costs, board diversification. A common rule of thumb you hear in personal finance is to invest around 20% of your income consistently for decades. That's not the only way, and it won't be equally easy for everyone, but it's a helpful target because it's simple, measurable, and powerful over time. Even if you can't do 20% right now, the system still holds. Start with 5%, then 10%, then 50%, and build towards 20% as income rises or expenses fall. The key is that you build a habit that doesn't require constant motivation. Let's do a clean example. Step 1. Define your expenses. Assume your monthly expenses are €1,000. This means you need 12,000 per year to live today. But financial freedom in the future needs to account for inflation. Step 2. Adjust for inflation. Let's assume prices rise about 2% per year. So your 12,000 year today becomes about 21,336 a year in 30 years. That's because 12,000 times 1.02 equals around 21,736. So, if your lifestyle costs €1,000 a month today, you might need roughly 1,811 euros in month in 30 years to live the same way. Step 3. How big does your investment portfolio need to be? This is where withdrawal rules come in. Option A. 8% rule. That's aggressive one. If you assume you could withdraw 8% of your portfolio each year, you would need 21,736 divided 0.08 equals around 271,704. Option B. 4% rule. It's more conservative and widely referenced. If you use the 4% rule, you need 21,736 divided 0.04. It's around 540,408. What's the difference? The 8% assumes higher withdrawal and more risk. 4% assumes more safety, more buffer, and more conservative long-term planning. If you want a calmer life, the conservative option is usually physiologically easier to live with. Step 4. What would you need to invest each month? Now, let's assume hypothetically 8% average annual return, compounded monthly. Markets don't return the same every year, but this is a common long-term stock market estimate. To reach 271,704 euros in 30 years, you'd invest about 182 a month. To reach 543,408 in 30 years, you'd invest about 365 a month. And this is what's important. Those numbers are not magical. They are simply the result of consistency and time. If you invest more, you get there faster. If you invest less, it takes longer. If returns are lower, you adjust, but the framework remains. People underestimate this because they focus on the wrong things. They focus on finding the perfect stock, timing the market. What if I start late? Or I need more money first? But most of the outcome comes from your savings rate, how long you stay invested. This is why boring strategies win. Not because they are exciting, because they are repeatable. Should you use financial advisor? This is where people get conflicted. Some financial freedom educators argue strongly against financial advisors, not because all advisors are evil, but because incentives can be misaligned. For example, financial author G.L. Collins has written bluntly about why he doesn't like investment advisors, pointing to the way fees and compounds can influence recommendations. The core concern is simple. If someone earns more money when you buy certain products, their advice may not be purely for your benefit. And John G. Bogle, I'm sorry, I'm probably saying the name wrong, founder of Vanguard and a major voice in low-cost investments, famously argued that costs matter deeply over time. In a keynote speech titled "In Investing, You Get What You Don't Pay For," Bogle emphasizes the drag that fees create on long-term returns. A more nuanced reality. Not everyone should avoid advisors entirely. Sometimes you may need help with complex taxes, business finances, inheritance planning, legal structures, or emotional discipline if you panic sell. But if you do use an advisor, many people prefer fee-only advisors, ideally with fiduciary obligation, meaning they are required to put your interests first, depending on your country's rules. Main point, you should understand how they are paid and whether their incentives align with your outcomes. Okay, but what do I actually invest in? A common recommendation in the financial independence world is to avoid trying to pick winning stocks and instead buy bored, low-cost index funds. Vanguard itself explains index funds as a way to track a market index, like the S&P 500, giving you a small piece of many companies rather than betting on a few. For example, Vanguard's S&P 500 ETF describes its goal as closely tracking the S&P 500 index, which represents 500 large US companies. This approach is popular because it is diversified, low-fee, passive, and hard to mess up if you're holding long term. Why people like index funds? Active managers often underperform. One reason index investing became so dominant is that many studies show active funds fail to beat their benchmark over long periods. SPIFA year-end 2024 discussion notes that over the 15-year period ending December 2024, there is no categories where a majority of active managers outperform their benchmark. This doesn't mean active investing is impossible. It means it's harder than it looks. And fees make the hurdle even higher. So, if your goal is freedom, not entertainment, boring is often rational. The part people avoid: behavior. Here is the uncomfortable truth. Financial freedom is less about intelligence and more about behavior. People lose money by panic selling during downturns, buying hype, constantly changing strategies, trying to catch up with risky moves, lifestyle inflation, spending rises with income. If you can master two behaviors, you're already ahead. First, invest consistently, automate it if possible. 2. Stay invested. Don't sabotage yourself emotionally. This is also why the 20% for 30 years idea works, because it's not fragile. You don't have to be perfect, you just have to be consistent. If you want to go deeper, here are two books often mentioned in this space. Ramit Sethi, I Will Teach You to Be Rich. System-based personal finance, conscious spending, automation, and Robert T. Kiyosaki, Rich Dad, Poor Dad, Mindset and How Assets Differ from Liabilities. Even if you don't agree with everything in every book, reading them helps you build a money vocabulary, which is the foundation of confidence. I titled this video, Everybody Can Achieve Financial Freedom, not because everyone has the same starting point, but because the principles are not reserved for special people. Financial freedom is not a secret society. It's a long-term outcome of spending less than you earn, investing the difference, keeping costs low, and staying consistent long enough for compounding to do its job. Start small, start calm, start now. Because the best time to plant a tree was 30 years ago, and the second best time is today. Thank you for watching, and I will see you in the next one.